Let's take a look at some of the market action in 90 minutes into the trading day. You're seeing stocks climbing today as Wall Street looks to close out a pretty tough week. Joining me now is David Wagner, Aptus Capital Advisors portfolio manager. And David, it was a really busy week between the Fed, updates on the economy, new inflation data out this morning. How are you looking at all of these data points when you think about the backdrop for stocks in 2025?
Yeah, no, thanks, Alexandra. Thanks for having me on here. But obviously the big news this week, you're right, there's a lot of noise out there, but it's what really came out of Jerome Powell's mouth just on Wednesday. It feels like the Fed's trying to get ahead of a lot of Trump's policies that he's going to try to enact over the next 12 months. What do I mean by that? Well, I see Trump as kind of the nominal GDP growth candidate out there because Trump understands, obviously, we have a debt ceiling crisis going on right now with the continued resolution. But he understands that the debt crisis needs to be, at least taken on right now. And the best way to take on the debt situation is one is austerity, two is to grow out of it, or three is to inflate out of it. And I think Trump's policies, and that's why I call him the nominal GDP growth candidate, is going to focus on growing out of it, but also inflating our way out of it. And I think that's what really Jerome Powell and the rest of the brain trust over at the FOMC committee is really worried about is just too much spending on the fiscal side. So they have to remain restrictive a little bit longer than originally anticipated.
So it seems like a lot of that uncertainty is driving the volatility that we're seeing in markets. So what do you tell clients during these tough days when perhaps investors are more nervous about their portfolios and what the future may hold?
Yeah, it's a great point right now. Obviously, this is kind of just more some short-term turbulence. But if, Trump enacts that nominal GDP growth expectations by injecting enough liquidity into the market, especially in areas of the market that could have a way, pretty high RRR and return from an overall GDP standpoint, like you just want to own stocks. And I think that given 2022 and recency bias, everyone is really afraid of inflation. But what they're actually worried about is unanchored inflation. When inflation is within a range of 2 to 3%, which is basically what the Fed is expecting moving forward, the best asset class to own is stocks. I just think that when rates stay higher for longer, you just cannot focus and depend on traditional fixed income and the merits and the ways that you've been accustomed to over the last 40 years as kind of being inversely correlated to stocks. So I think as the market evolves, you have to evolve your thinking and how you really prepare your overall asset allocation to, one, put more eggs in the basket of owning stocks, but also not relying on fixed income as much to protect capital on the downside, and yet be pragmatic on how you think on how there's different alternatives out there in this world to make sure that you do protect capital on the downside, because we all know the drawdown risks associated with investing.
So let's talk about some of the plays that you like. You continue to favor large caps over small caps. And I was just debating the small cap trade with my brother the other day, since there's been this hope that small caps could bounce back. But what's your expectation?
Alexander, this is a weird comment from me because I've run a small cap strategy now for 11, 12 years. So this is a small cap manager telling you that he still likes large caps right now. Though I would say small caps are, not all small caps are created equal. If you do passive investing on the small cap side, most people unintentionally don't know that they're investing 40% of their small cap assets into companies that just simply don't have profitability. So I love small cap quality right now, but I would still take large caps over small caps because of one really big reason. And that's the reason I don't think many people, have recognized an evolving characteristic of the constituencies within the S&P 500. And it's the fact that S&P 500 has operating leverage now. Obviously, you see that with next year's earnings per share growth for the S&P 500 at 15%, and that's off of revenue growth of only 5%. I would say that U.S. large caps are the only major asset class in the world that have this characteristic that hitches their wagon to. Small caps don't have it. Small caps are more service-oriented. International is more service-oriented, and EM is going to be more commodity based on energies, metals, and miners, and value-added services on the tech side. So operating leverage, when it's working for you, it's your best friend. But obviously it can cut against you and it can be your worst friend. But right now it's your best friend, though operating can cut both ways. I do think that within large caps, we're going to see more tails and returns, meaning that the good returns are going to be better than normal and the worst returns are going to be worse than normal. But right now, I want to follow what the market's telling me right now. Hey, invest in large caps right now.